Hey, everybody, welcome to the Effective Retirement and Tax Planning event and workshop. Today, we're going to be presenting a little bit about all of that to you. My name is Jeff Kickel. I am one of the co-hosts of the Sense of Things podcast. I'm also the owner of Sure Horizon Retirement Advisors and Freedom Day Wealth Management. Our presenter for today is Ron Lang of Atlas Wealth Management. Some of you will know him, some of you won't. Ron and I have known each other for many years and have worked together both as our businesses together, but also as co-hosts for the Sense of Things podcast. So welcome to the Effective Retirement Tax Planning Workshop. Ron, take it away, my friend.
Here we go. So I want to give everybody a heads up here before we really dig in. So you're not going to get a lot of fluff. And it's not the kind of fluff that you put on with your peanut butter and jelly sandwich. We're talking really blunt speak here, direct conversation about the markets, retirement taxes, and planning. These are the topics we're going to cover with you today. This is going to basically be like drinking from a fire hose. So we're going to go fast and furious over the next 45 minutes. And if you got questions, put it in your chat box and Jeff will bring them up as we go through it. So as Jeff introduced both of us, Jeff is with Sure Horizon Retirement Advisors. I am the principal of Atlas Wealth Management and the chief investment officer. So just to have a little bit of fun, take a few seconds here. This is one of my favorite things. What does a penny cost to make? Does anybody know? Now, just to let you know, I've been actually doing this one here for about 12 years, and I always update it every year. So what do you think it costs to make? Here you go. It costs 2.27 cents to make a penny. Sounds cost effective. What do you think? How about a nickel? What does it cost to make a nickel? Believe it or not, a nickel costs 10.4 cents to make. And just for giggles, this is what a dime a quarter. And of course, the most cost effective is to make a dollar. But of course, it doesn't cost anything to use your credit or debit cards. What we're trying to say here, folks, is that sometimes things just don't make sense. Let's dig into it. So no matter what age you are, whether you're 25, 45, or 65, you're going to basically go through two stages with your money, with retirement money, investment money, whatever the case may be. You're going to go through the accumulation phase and you're going to go through the distribution phase. Some people will end their accumulation and start the distribution phase in their 50s. Some will do that in their 60s, and some will do it in their early 70s. So what is accumulation? So accumulation is adding to your company retirement plan, adding to your legacy retirement accounts, right? You may have IRAs, you may have Roths, you may have a beneficiary IRA or beneficiary Roth. You may do annual contributions to your personal IRA and Roth. And of course, if you have an extended or a higher end household income, you could do a backdoor Roth if you wanted to. And then on a monthly basis, based on your budget, your surplus savings. You could always add $500, $1,000, $2,000 a month from your checking account into your investment account to be invested. What do we call that? You're building up a cash surplus war chest. And then here's the other thing we're going to talk about a little bit later. This is your accumulation phase. After the age of 59 and a half, you can consider an in-service distribution so you could manage the money, because as most company retirement plans limit you on the assets that you can invest in. So after the age of 59 and a half, many plans allow you to pull money out and roll it over into an IRA so you can manage it on your own. So when you're going through the distribution phase, this is when you're going to be distributing from either your investment account or from your IRA accounts. We always try and tell people, draw from your Roth last. Why? After the age of 59 and a half, your Roth becomes a tax-free piggy bank. So knowing that, why would you want to touch it? Because as soon as you take the money out, you can't put it back in. So as long as it's a tax-free piggy bank, just keep letting it grow tax-free. So during the distributions, you could also move your RMDs when you're of that age into your investment account and invest them appropriately. We actually have some clients that will take a portion of their RMDs or all of their RMDs and actually donate it. So they can put that into a charity. They could do a qualified nonprofit. It's affectionately called a QCD, a qualified charitable distribution. So you have different choices here, but just to let you know, here are your two categories that we're going to be really drilling into. So again, a lot of people always talk about the total that they're building up. It's not about how much you make or accumulate over time. It's about how much you keep and not paying in taxation. And that's an important rule to remember. So one of the things that you want to do is you want to think about how much do you need annually to retire on. Now, there's a lot of good retirement calculators. I know Jeff has his methodology. We're just going to do some quick, dirty math here. So let's just say you want $100,000 a year in income without touching principal. Multiply that by 22, that's 2.2 million. That means that your bogey, your goal is to have at least 2.2 million when you retire to live off of. Essentially, how we do this, we know that we could generate at least 5% a year for you. So if you have 2.2 million, you could live on $100,000 a year without touching principal, not including Social Security. So again, this is just some quick, dirty math for you to think about where you are and where you want to be. So just very quickly, what we do is, again, one of our goals is to get our clients to save enough money so this way they could just live off the dividends and the interest. But depending on how much income they need on an annual basis, what percentage of the portfolio needs to be put into the income generation bucket. So this way you have another portion of your portfolio that's just in conservative growth. Why? What happens if you need a new car, new roof, new HVAC? Something happens with the kids or grandkids, you need to give them money. You're not going to take it out of your income bucket. You're going to take it out of your conservative growth bucket. So these are some of the things you want to think about as far as how you want to divide up your portfolio. So what does this mean for you? We're going to give you a couple of quick examples. If your portfolio size is 1.5 million and you only need $50,000, not including Social Security, then this is how you divide it up. You're an 80-20 scenario. 80% goes into the income bucket, 20% grows conservatively. Here's another reason why. In 10 years, you may come and say, hey, Ron, hey, Jeff, we need another $500 a month. Where's that going to come from? Not Social Security, not income. It's going to come from the conservative growth side of your budget. So you harvest off some money and profits from there, put it into the income bucket, and generate more and more funds. So putting in a plan, I know that the screen is busy, but this is the kind of analysis that you want to be able to do here when you're really breaking this down, depending on how many years you need to go for retirement. 3 to 5 years, 6 to 10 years. Obviously, we have ups and downs in the market. We can't control that. If Jeff and I could control the market, we wouldn't be talking to you today, would we? So what you want to be able to do here is you want to make sure that you know when you want to pull that ripcord. Now, as I've always said to people, and Jeff and I have talked about this in our podcast, there's a huge difference between you have to work and you want to work. If you have to work, some of these numbers may not jive well. But if you want to work, this is a little bit easier to put together a plan of when you want to retire. So this way, when you are working, you don't need to worry about exactly how much you keep adding to that nest egg. So this is the 80-20 scenario. This is a 70-30 scenario. So 80-20 is ideal. 70-30 is optimal. If you could get to 60-40, that's even better. Obviously, then you've accumulated a lot more during your lifetime. So the more that you can put on the conservative side and just live off of the income, the better life you're going to have, just as far as not necessarily relying on, do you need to work? And if the kids or grandkids, or you need to help family members, or you want to donate to a charity or nonprofit, that's going to give you that much more flexibility. So annuities. A lot of people always talk to us, to Jeff and I, about this. Jeff and I are licensed as an insurance producer. I will tell you, it's part of our methodology. Insurance or annuities is not a primary part of the investment portfolio. I know Jeff has his views on it. I typically will tell people, if you're very risk averse, if you have health situations, health condition, or special needs, a portion of the portfolio should absolutely be considered for a fixed indexed annuity. I am not a variable annuity person. Fixed index annuities have less cost to it. Variable annuities have higher cost to it and are actually have a investment component. Here's another thing. A lot of people don't realize annuities is not an actual investment that is, let's just say, the oversight is by the SEC or FINRA. An annuity is an insurance product, and a lot of people don't realize that. Here's some of the things to consider. Do you have a medical or special needs situation? Are you a low or no risk person? These are some of the things that you need to think about. Just for our methodology, if we do get you into an annuity, typically it's short term, 5 years or less. You could always extend it out. You could always ladder if that's a good situation for you. But other than this slide, we're really not going to be getting into annuities today. All right. So a lot of people also have some confusion on the difference between ETFs and mutual funds. My motto is we are crusaders against Wall Street greed. So what most people don't realize is what are the fees involved with many mutual funds. Look at them in your 401ks or your TSPs or your 403bs. Usually mutual funds have much higher fees than ETFs. And mutual funds, this is how, quite frankly, Wall Street has really made their money off the average investor. When you want to buy a mutual fund or when you want to sell a mutual fund, it's only done at the end of the day. Typically, they're higher in fees. Some are front loaded, some are back loaded. And many times you need to check this, but your advisor could be double dipping. If they're a hybrid, meaning if they're both a broker and an investment advisor, their firm could be getting a backdoor, essentially, I'm using backdoor, but it's essentially a trailer commission on all the mutual funds that you own. ETFs, exchange traded funds, have been around over 30 years. It's essentially a mutual fund that trades like a stock. Most fund companies were forced to add ETFs because people wanted the ETF option because you could buy it at any point during the day. And for similar strategies, ETFs are typically 50 to 80% less in fees than mutual funds. I have not been in a situation yet, and Jeff, maybe you can confirm or maybe you have a different story here, but I haven't been able to find it yet where a client has brought me a mutual fund that they liked that I did not find an equivalent ETF with the same strategy that was equal to or better in performance or 50 to 75% less than in fees. So whatever mutual fund you have out there, you can almost find an equivalent ETF that is probably better for your portfolio.
And that wasn't true 5, 7 years ago,
No,
especially some of the more esoteric or different strategies, maybe like sector strategies and things like that. ETFs weren't there. Now there's virtually an ETF for everything, including some that you couldn't find in the mutual fund world. So there's more product development going on in the ETF world.
and it's been by demand. It's absolutely been by demand. Okay, so what we want to do is create an efficient income strategy. At the very end, there's going to be a QR code if you want to get Jeff's book. Him and I are go back and forth here on some of the taxes that you need to be aware of. And one of the big things is we just got through a hellacious political season. That taxes are always a political football, and the tax code from 2017 is expiring the end of next year. We'll have to see how many changes may or may not be done. But I want to address one thing here. I've been quite surprised in many of my meetings with prospective clients and clients that people didn't realize the differences between interest income and dividend income. So very quickly, any interest that you get from a high yield account, CDs, account interest, money market are all taxed at ordinary income rates, meaning your tax bracket. But dividend income, stocks, preferred stocks, many ETFs, many mutual funds pay dividends. The maximum you're going to pay on any dividends is 20%. So if you're a high income earner and you got a lot of money in a money market or a high yield account, right? Let's say you're in the 27, 28% tax bracket, you earn $100,000 a year. You're going to pay $28,000 on that interest. But if you had $100,000 in dividend income, you're only going to pay a max of $20,000. I think you can spend that extra $8,000 a lot better than the government. So I think it's very important that if you're not aware of this, that you should be, because it would affect your portfolio makeup. Municipal bonds and treasuries. You could only buy municipal bonds. Excuse me, I shouldn't say this. I should say it a different way. If you're going to buy municipal bonds, you got to put it in a taxable account, a brokerage account, investment account. But if you want to take the full advantage of a municipal bond, you got to buy the municipal bond in the state. I just had a situation where a client moved from Massachusetts to Arizona a year and a half, 2 years ago, and still had Massachusetts municipal bonds. They don't get the tax advantage of that because they're not living in Massachusetts anymore. So this is one of the things you want to think about. And also treasury interest income. It's not based on ordinary income rates or taxes. You only pay federal tax on treasury interest income. And a lot of people are not aware of this too, because everybody's been putting all their money in the high yield accounts when they were above 5%, when they could have considered a municipal bond, when they could have considered a treasury bond or note, or even preferred stock, because preferred stock pays a dividend. So see, these are some of the things that you want to think about too, because even with the municipal bonds, you got to think about your net, because if you're even, you got to be, if you're getting a 5% dividend yield on securities, well, a lot of people love their municipal bonds, but for equivalency, you better be earning at least 3.8% yield on a municipal bond, because if not, you're better off just owning just something that's dividend oriented, that's paying better than a 5% yield. So just a couple of examples here, and then I'll let Jeff kind of chime in here, is we got two examples. So on a non-tax advantage account, there's something called tax harvesting. This is the big time of the year to do it. So basically what you're doing is, if you think about it, you have two long-term positions with an unrealized gain of 40,000. You have four long-term positions with a realized gain of also 40,000, 45,000. So the idea at the end of the day is you want to be able to offset cost. So this way you're not paying the taxes on it. So if you have something at a loss and something at a gain, you can offset it to raise your cost basis. You just need to make sure that you're waiting 31 days to buy those shares back, or else it's called a wash sale, which is a no by the government. Your net balance is basically the same if you're buying it back at the same price. All you did was, let's say, raise your cost basis from 25 to 40. So now down the road, if you end up selling it at 50, you're not paying a $25 profit difference. You're only paying a $10 profit difference. And then example number two, and we just went through this, is based on where you are buying and selling it, you need to do tax harvesting. You don't need to do this in an IRA or Roth account, right? You only do it in a brokerage or investment account. Jeff, maybe you have another example that you can give.
I think the other piece of it is, looking at the structure of your accounts when it comes to, and I know we're going to discuss Roth conversions coming up, what you want to start doing. And for those of you that are not quite to retirement yet and maybe have 5 or 6 years, it's the time to start looking at what taxes you will be paying when you're in retirement, because that's going to affect what your taxes are on Social Security. It's going to possibly affect the amount of money you're paying for Medicare, which a lot of people don't realize. Honestly, before I wrote the books that I've done on Social Security and Medicare, I really didn't think about this. And now I'm much more conscious of the tax components, because it could be a significant amount of money from especially a Medicare perspective. You don't have to make a lot to have to pay more for Medicare. And it is a graduated scale depending on how much income you make. If you've been used to making 120, $130,000 a year, you're going to be paying almost the maximum for Medicare in those cases. You're going to also be taxed on the maximum that the government can tax you for Social Security. Now, that might change with the new upcoming administration. That was one of the things that had been talked about, but we have to look at it as it is today. So, what I would say is, whoever you're working with, make sure that you are sitting down and having conversations around, okay, how should my assets be structured to make sure that I'm prepared for retirement? And that includes investment accounts and brokerage accounts.
Yeah, absolutely. Good point. Really good point. And if you're not aware of Jeff's books on Social Security and Medicare, you should certainly check them out. So I was also quite shocked that people were not aware of the new RMD requirements. So this is from the Secure Act 2.0. I think it was passed in 2022, that it's all based on 1949. If you were born after 1949, then you don't have to worry about RMDs until the age of 73. Before 1949, it's 70 and a half. The government wants their pound of flesh. So the first couple of years is much higher. But all you got to do is just move it out of your IRA, put it into your investment account, and let those investments work for you. And if you could do it, do your RMD in the first quarter of the year. This way, it's going to work for you longer, and you don't have to worry about if you haven't satisfied your RMD by November or December. Also, I wanted to add this in here, the gift allowance, meaning that you could give up to $18,000 a year to anybody, maybe start with the family members first, but you could give up to $18,000 a year to anybody without a tax burden to you or to them. And the nice thing about the gift allowance, it's like giving away your estate before you pass without the government getting their claws into it. And just to give you a heads up for next year, for 2025, it went up 1,000. So it's now going to be 19,000 for a gift allowance.
And that, Ron, that's per individual. So
Per
a
individual.
married couple can each give $18,000 to
Correct.
one person. Now, giving to a charity, there is no limit, but giving to another person, it's 18 grand per person in the family.
Yep. Or look at it as per parent. That's the other way to phrase it. So, yep, good point. So Roth conversions, I know Jeff and I are probably 70 to 80% on the same page with Roth conversions, but really what it comes down to at the end of the day is everybody's different. If you're already in retirement, depending on how much you have, it really doesn't make sense to do a Roth conversion. And also, if you have 5 years to go, it's tough to say if you want to do a Roth conversion. But I do tell people, if you have at least 10 years to go, whatever percentage of your IRA that you want to convert, do it in the first couple of years. So this way you have 6, 7, 8 years for it to grow tax-free and make up for the taxes that you're paying up front. Obviously, we don't know what the new tax rate's going to be after next year. They want to keep it the same or lower it. And if you're making under $400,000 a year, you're not really in their crosshairs. But a lot of this has to be around duration, about when you are looking to retire, because as I said earlier, the Roth account is the last account you typically want to touch for your income if you can avoid it. And also another great time to do it, when we don't wish for it, but let's say the market steps in a significant pothole, maybe the size of a swimming pool, you want to do a Roth conversion then, because you don't know if it's a knee-jerk reaction or not, but the market always has a way of finding its way back. So if we get a 5 or a 10 or a 15% pullback in a short period of time, that's when you want to push a little bit more of a Roth conversion to get done sooner than later. Because on those, remember, it's the escalator up and the elevator down in the market. When the elevator goes down, that's the time to do your Roth conversion. Before I go on, Jeff, I didn't know if you wanted to add anything because I put together a sample schedule.
So the only thing I would say is you don't want to do massive Roth conversions in the final 2 years before you turn age 65. The reason for that is if you do these massive ones and it increases your adjusted gross income, there's a 2-year look back on Medicare. And so that locks in, that could end up locking in the higher Medicare amount. And then it doesn't matter if I've got a bunch of tax-free income, well, I'm still paying the maximum for Medicare. So that's one of those things that the sooner rather than later, it's better to make your Roth conversions and get those down prior to getting to age 65, because age 65, regardless of when you retire and take Social Security, at age 65, you have to file for Medicare, Parts A and B, and technically D.
No, it's a great point, because when people are thinking of Roth conversions, they're not thinking about Medicare. All right. So anyway, as I like to say, you could put together a schedule. Again, this is just an example of how you may want to do it. If you want, do more up front. So if you have 10 years to go and you really want to convert a chunk of it over time, do the bulk of it in the first 2 years. And then you could decide where to go. Now, I put this together before the presidential election. Obviously, a lot of this is going to depend on what the taxes are in 2026 and forward from there. Again, typically I like to do Roth conversions in January and February of the year. Why? Because if you do it in January or February, you don't have to pay the taxes until April the following year. So you could let that money work for you for 15 or 16 months to help pay for whatever taxes you're going to incur. So more control of your retirement. We had talked about this earlier to tease you a little bit, but if you're over 59 and a half and your company retirement plan offers an in-service distribution, consider it. I've had clients that I've only had one client that had a unique situation, which I'll talk about in a second. But let's say you have $500,000 in your 401k and you don't like your investment choices and you got high fees on those funds. Depending on what the plan provisions are, you could move some, most, or all of it, roll it into your personal IRA or Roth and manage it on your own. A lot of people don't realize that you can do this and they think they're just completely handcuffed with their company retirement plan that they're just limited until they retire or quit. It's not true. I only had one circumstance with a client 2 years ago, had about $500,000 in his 401k, and who the custodian was, I won't mention their name, only limited at $25,000 for an in-service distribution. It was the only time ever with all the clients that have done an in-service distribution and roll their money out that they were limited at any particular amount. So this is something that you should or could look into. I'm not going to read all this to you. You could pause the video when you look at it, and you could read a lot of the other details here. But when you're in more control of your money and paying less fees, that means your net return down the road is only going to be that much better. So, a couple of things to think about and consider: emotions and risk, right? It's tough to unplug yourself from emotions when it comes to money because money is emotional. Fear. If you truly are losing sleep because of the market pullback or conditions or the future, then you don't have the correct portfolio allocation. You're not getting the right service for somebody to explain it to you. And if you're just having anxiety and your stomach is in knots, then you should probably go to cash. Not recommended, but certainly you shouldn't be losing sleep. What is your risk tolerance? Do you know? At the very end of this, you can scan our QR code and actually take a risk assessment on a scale of 1 to 99. And just so you know, the S&P 500 as a broad-based index is a 73. So if you're above a 73, that would typically mean that you don't mind more risk and you don't mind trying to outperform the market. A lot of this is going to depend on your stage. If you're below a 73, that means you're a little bit more risk averse. I've had situations recently where people were in their 20s and 30s. I had somebody that was a 29 and the portfolio they wanted to bring over was an 83. And I'm like, something doesn't jive here, because that means as a 29, not only you risk averse, but you really don't want to lose any money at all. But your portfolio is saying put risk to the wind. And the portfolio, like everybody else, has done well in the last 2 years. But really what it comes down to is that your comfort level when it does come to risk. So just some important concepts about the market. Number one, when you want to follow trends, the bond market is typically ahead of the stock market and the stock market is ahead of the economy. Typically 9 to 12 months. Could be sooner, could be later. 9 to 12 months is the average. Rate hikes and rate cuts typically take at least 6 to 9 months before they have an effect on the economy. Remember in 2022, the Fed just poured cold water on the economy with all of the rate hikes. Really didn't feel it. Really didn't see inflation come down for another 12 to 18 months. So that's why you really need to think about, everybody wants a quick fix and a little pixie dust poured on it. But you know what? You need 6 to 9 months before you see the effects, positive or negatively. So one of the things that a lot of people need to remember is, on average, on an annual basis, right? There's about 5% pullbacks annually. There's a 10% pullback about every 16 months, 15% pullback every 3 years, and a 20% or more pullback about every 5.5. People have just been spoiled in the last 15 years, folks, right? The market just keeps going up. And I've had people where I had to pull back from the edge of the cliff when the market was down 1.5%. Oh my God, is this just the beginning? That's the problem. Maybe you're in the wrong portfolio allocation. Perhaps you're a lot less riskier than you actually know. But this is important to remember. These are just average pullbacks in the market over the last 100 plus years. So what didn't we cover in today's presentation? We didn't talk about healthcare or possibly long-term care. We didn't talk about really Social Security. We did a workshop last week on Social Security. We'll be doing more in the future. Jeff wrote a terrific book on Social Security that you can get. Put it into the chat. Estate planning. We got a workshop next week that we're going to be doing on estate planning, which is a skinny version of the workshop that I do in person. And we didn't talk about a trust, setting up or modifying a trust, which is pretty critical to preserving and distributing your estate when that time comes. So very quickly, we're just going to do a little checklist. I love checklists. I'm a big action item guy. So if you have less than 5 or 10 years to go to retirement, or you need income from the portfolio, you need to consider a Roth conversion. And remember, how your neighbor may be doing a Roth conversion isn't the same on maybe how you should do or consider it. Maximize your 401k contributions on the Roth side of the account if you have that option in your 401k. If you're over an income threshold, do a backdoor Roth. What's the big deal? This way you can manage that money on your own, whether you can or can't do it in your company 401k. Put together a financial plan. Jeff and I are at heart are financial planners. And not that you need to measure and manage every penny, but you need to have a plan in place. You need to know over the next 3, 5, 10 years. We don't know what's going to happen 3 to 5 days from now, but putting together an idea of what your expenses are. And please don't have any credit card debt. But 16 to 22% interest, it's ungodly, and it's now approaching 1.2 trillion. And also, whatever you paid off your credit cards with, you can now pay down your mortgage if you still have one. Put away half of your monthly cash surplus into an investment account, into low risk, low volatility assets. As I like to say, that's building up a cash surplus war chest. If it's automatically taken out of your checking and savings into the investment account, it's not available for you to spend right away. Understand your risk assessment numbers so you can diversify your portfolio appropriately. Again, what is your portfolio risk as opposed to your risk? Do they jive? And analyze the best time to take Social Security. I'm knowledgeable in Social Security. Jeff is an expert. Like I said, he wrote a really good book on it you should get. Again, just a couple more things. Understand the tax bracket you're in and make changes if you are directly in the crosshairs of the politicians next year. We'll have to see. If you're over $400,000 a year, maybe there are some adjustments you want to make here over the next year. Take advantage of the gift allowance. Remember, you can do $18,000 this year, $19,000 next year. Give it to your kids or grandkids. Get them investing early. Set up a custodial account for minors. And a lot of people are not aware you can do a Roth account for minors. Get them going early. You don't have to fund it every year, but just fund it for a few years, right? That money will double every 7 to 10 years for them. And obviously, they won't be able to touch it for 45 to 50 years. Tax harvesting, we went through it quickly. It's a more complex subject, but tax harvesting could save you tens of thousands of dollars in the future in retirement. And QCDs, right? With your required minimum distributions, you can actually do this instead of paying taxes, donate that money, right? Just another consideration for you. So before you leave, we would love your feedback. Here are our email addresses. You can reach out to us. And if you want Jeff's book on the retirement income equation, click that QR code. And if you want to take a quick risk assessment survey, here's a QR code for that. So we'll just open it up to any questions and we'll let you guys go. And we're finishing right on time. I don't think we get any extra gold stars for that, but we did our best to get as much as you can. Like I said, it's like drinking from a fire hose, or the other way to describe it for all the drinkers in the room, it's like trying to fit a gallon's worth of water into a shot glass worth of time. So we did our best. Jeff?
Ron, don't seem to have any questions. If you do have any questions, hit the down at the bottom of your screen. There's a little Q&A button there. You can click on Q&A and that'll bring up a little box and you can type a question in there. Or you can type it into the chat as well, the webinar chat, which is right next to or two over from there on the left-hand side. So it says chat. All right. Forever hold your peace. Folks, we really appreciated having you guys on today. If you have any questions, feel free to reach out to Ron or myself. Ron is one of the best investment managers I know. So feel free to ask questions there. If you have questions on Social Security, Medicare, or long term care, feel free to reach out to me and I can answer those questions and I can send you a copy of the books that I've written on those areas. So thanks a lot and have a fantastic day the rest of the day.